Good morning, good afternoon. Wherever you are joining us from, thank you for your time today, taking part in CyberCube's Need to Know webinar, Key Considerations when Broking and Underwriting Cyber Risk. I'm Oliver Brew, Head of Client Success for CyberCube, and we have an extremely knowledgeable panel of industry experts here today. I can't promise they'll have all the answers to underwriting and broking, what is undeniably a complex and dynamic risk, but I can assure you they will have some valuable insight. We'll be kicking off with some unique perspectives from Laux. They are focused on supporting the cyber insurance market, ensuring its sustainability, and developing the regulatory framework to help understand the risk. One area to be explored is the development and use of cyber realistic disaster scenarios. You will have time to ask questions, so please do type any queries you have in the Q&A box. Before I introduce our panelists, a little about our company. CyberCube was incubated within Symantec in 2015 and has been a standalone business since 2018. We help the cyber insurance market to grow profitably through the use of our risk analytics, aiming to enable society to make better decisions about which digital risks to avoid, mitigate, or insure. Our webinar is broken down into 3 segments. Initially, John Laux, our VP of Analytics, will be in conversation with Emma Watkins, Head of Exposure Management and Aggregation at Laux. Following that, I will be talking with Chelsea Law, Product Advisor, focused on underwriting issues. After her, Will Hatcher and I will be discussing broking tips. And with that, I'll pass it over to John.
Ollie, thanks. Good morning, good afternoon, everybody. Emma, it's really nice to take some time and be here with you. So I thought, let's just get right into it. I think setting the stage, the way I see it, Laux has 2 main responsibilities with respect to the cyber insurance market. The first is to support the growth of the market and deploy Laux capital to that end. But obviously that needs to be balanced with protecting the solvency of Laux and promoting responsible risk-taking within that market. So could you speak a little bit about the role you see Laux playing toward each of those objectives and the ways that they might conflict or support each other in that regard?
Sure. Hi, John. Hi, everyone. Thanks for having me here. So yeah, that's exactly the kind of question that I used to ask myself before I joined Laux. How do we balance this possibility that if we get excited about growing a market, we could take our eyes off the ball when it comes to managing the risk and doing it carefully. But really, they do support each other. The key is the word responsible. We take risk responsibly. And if we make sure that as we're taking the risk and as we're growing the market, we're doing it thoughtfully, then we can protect the solvency of Laux. And we can take comfort in the fact that the market is sustainable and that we're not just going to be in it for the short term. Because after all, who wants to hugely grow a new market only for it to be the thing that blows up in our faces and means that we're not here in 5 years' time? So while on the face of it they could be in conflict, they're really not. And what we're trying to support right now is growth in the cyber market, but thoughtful growth.
Yeah, that makes sense. So as Ali mentioned, one of the forms that takes is stress testing. And at Laux, that's typically called realistic disaster scenarios, or what we call RDSs, right? And you've got them for many, many lines, including now 4 for cyber as of the start of this year. And I think this is an interesting area to dig into, just to think about, what that means for insurers and how that might translate through for agents and brokers as well. The scenarios are deterministic in nature, which I think I'm sure there's reasons for that, which I'd like to get into, but a lot of the market is also interested in probabilistic analysis, that you can look at the likelihoods of different kinds of outcomes. So could you speak about Laux' philosophy with RDSs and the motivation that you have for the framework that you've built?
Sure, yeah. So RDSs as a framework and as a tool were introduced quite a long time ago now to the Laux market, starting off, I think, for natural perils and then we moved into developing scenarios for other lines of business outside of natural catastrophe. And actually, the primary purposes for which we had RDSs still remain valid, and they're still a really great tool for helping us to understand and control the aggregation of risk across the market. They help us understand the aggregate risk, as I said, but also then the risk to syndicates and the risk to syndicate solvency, and also to liquidity in extreme shock events. We know, though, that they're now also used around the world for all sorts of different purposes. And it's absolutely true that there are also more advanced ways now for insurance companies to understand their exposure and look at their risk aggregation. And probabilistic analysis is really important to everybody in the market. Clearly, an RDS by itself is just a scenario. It's just an estimate of the loss that could occur if something happens. So it tells us about the severity of a type of risk, but it tells us nothing about the frequency. And really, you need to understand both of those in order to inform pricing and capital setting, amongst other things. So we start with the RDSs, and as you pointed out, we now have four scenarios which are cyber-based, cyber risk-based, and we look at the losses coming from those scenarios, and then we start to try to assign probabilities to those losses. And that's, at the moment, that's a very subjective, expert-driven approach. We don't have precise models that can honestly, realistically, factually tell us what the probability of a certain loss is, but we can get there. We can get to an estimate, and if we put enough rigor around that process, then that can be a really helpful tool to have. And then from a selection of scenarios and perhaps some probabilities around those losses, you can begin to build out a probabilistic kind of analysis. And then one day, maybe you have hundreds of thousands of potential scenarios, each with an assigned probability, and you end up with a fully stochastic model. But I'm not sure, well, Lloyd's certainly isn't there yet, but we're watching the market to see where syndicates go, and to see where everybody in the market goes in terms of developing those models. There are obviously still other limitations to the deterministic framework, such as, we can't have an RDS for every single potential future scenario. And the one thing we can guarantee is that whatever happens tomorrow or one day down the line, it won't be an event that we've got an RDS for. So it won't be something that we've got a nice pre-packaged understanding of. It'll be something different. And we also know that if we set some specific scenarios, then perhaps it will be possible for the market to underwrite around them. And so, if we have a scenario around ransomware, then underwriters could stick an exclusion into their policies so that they couldn't have losses to that scenario, and we end up with a completely useless scenario. But we do work to try to avoid that happening, and there are still plenty of ways in which I think deterministic frameworks are really helpful. They're simple, they're very easy for everybody in an organisation to understand. They're repeatable, they're an exercise that you can repeat time and time again to see how results change over time. And we can make them consistent across the market, so that we know that every syndicate is producing an estimated loss to the same scenario, and then we can add them up to create what is a realistic loss for the market as a whole.
Yeah, that all makes sense. And I think the importance of transparency, I think, in this space is really important. And so that's important. It's important to build on. We don't want, I think we're just seeing cyber is not the kind of thing where we can afford to just have it be a black box where we don't really understand what the numbers mean. It's much better to be able to have a thoughtful dialogue around what the numbers mean and be able to look at them over time. Certainly a lot that goes into it, and it sounds like you're on top of it. I think one of the things we grapple with when we're thinking about models is exactly what you said, that the thing that may happen may not be any of the exact scenarios that we plan for, but we need to kind of be flexible enough in our thinking to embrace that. Just curious, cyber has obviously grown a lot over the last number of years, especially the last couple with the changes in the market that I think our colleagues will get into a bit later. Back when this framework first started, cyber was probably a pretty small thing compared to the natural catastrophe exposure in the market, in terms of like the numbers that might come out of a scenario like that. Where would you say things are now? Is it still kind of relatively minor compared with, say, hurricane and earthquake risk, or has that gap closed some?
I would say that gap has definitely closed some. It really depends on which measure you use. So we do have some natural catastrophe scenarios which produce losses to the market of a similar level to some of the cyber scenarios we have. But also we have some nat cat scenarios that produce much, much bigger losses. And we haven't yet designed a cyber scenario that can produce losses to the same magnitude as, say, a Cat 5 hurricane in Miami. But that's just because we haven't contemplated that scenario yet. We don't know actually whether or not, how big the loss could be to the market. And that's partly why we have to do this so very, very carefully, and keep refreshing the RDSs to make sure that the scenarios we're using are focusing on the types of risk or the types of peril where we have the most exposure, and make sure that they're up to date for what the hazard is out there, the kinds of things that can happen.
Yeah, it makes sense. So I suppose a follow-up then, just thinking through how these stress tests get applied for the folks in London who are underwriting. Of course, the syndicates play a huge role in supporting risk-taking in the cyber market. When you're looking at the results of a stress test, what's most important in terms of the numbers that you see coming out of the syndicates? Is it the absolute number? Is it kind of relative to the stamp capacity or the capital that they've allocated to cyber? Is it how that number's trending as you look at it over time? Just appreciate your thoughts on that.
Yeah, they are, as I said, they're used for so many different purposes, and all of those things we do look at. But I suppose if I strip back, what my team's role is to protecting the market and protecting the solvency of Lloyd's as a whole, then probably the most important thing, and to be honest, the first thing we look at is the results, syndicates' net losses versus capital. Are syndicates well capitalized enough to withstand these kinds of scenarios? Lloyd's has some fairly strict rules around how much capital needs to be held against extreme scenarios, and it's a difficult framework to maintain because it can really depend upon the severity of the scenario that we're looking at. But essentially, what we do is we set a rule so that a syndicate could realistically sustain 3 RDSs in a given year without exhausting its capital and profit. And that's what we look at first, and that's where that rule is in danger of being broken. That's where we first start to ask questions. We do also look at the trends. It's very helpful for us to see where syndicates are growing or not growing. It's also helpful in validating what syndicates are telling us about pricing in the market. If premium is increasing, but RDS exposures are not increasing, then we know that it's all in the rate. But if exposure is also increasing, and syndicates are telling us that rate increases, but exposure is increasing, then perhaps it's not as much in the rate as we thought it was. And then one final thing I wanted to say is about outwards reinsurance or ceded cover. We look at the ratio of gross losses to net losses. And we, in the RDS submissions, we actually look at which reinsurers are sort of on the hook. So we're managing the credit risk in the market, and we're managing the concentration that we might have to single reinsurers in the event of a really severe event.
Sure. So when you said 3 RDSs per year, that would be maybe, say, a hurricane event, a cyber event, and a terrorism event. Like all those could be, you have to be prepared for all those. So
Yeah.
Makes sense. When you're looking at those, just curious, as you think about the cyber market right now, are there things that you see that are concerning you, or that, if things change, would concern you?
I think, unbridled exposure growth concerns us, and when we see numbers, potentially increasing 20-30% in terms of exposure, not premium so much, but in terms of exposure year on year, then we like to understand exactly how syndicates are managing that, and what tools syndicates have, and how closely they're watching their own growth. That means that we need to be really, really careful. It's concerning that we don't yet have, I don't think, as good an understanding of the risk landscape as we'd like to. We've been using exposure management and modelling techniques on natural catastrophes for decades now. And that's not to say we absolutely know what's going to happen tomorrow or what our loss is going to be, but I think we certainly do have a much better understanding and have more confidence in the numbers that we see for those perils. Whereas for something like cyber and other emerging risks, we have to add a little bit of conservatism around the numbers, or at least take a little bit more prudence in our approach, because at this point we're just not sure what's going to happen.
Sure. Yeah, of course. Maybe to ask the opposite question almost. One of the interesting things we've seen with the market in the last, call it 2 years, in response to ransomware has been rates have gone up significantly, and exposure, if certainly not across the board, but for many, exposure, if anything, has actually decreased a bit in terms of reductions in limits, more careful underwriting. And one of the upshots of that from market dynamics has been that companies are hitting their allocated, stamp capacity in terms of premiums sooner, without necessarily putting out as much capacity. And so there's actually a way that some of the regulatory constraints are actually making the market maybe harder than it otherwise would be if the framework were applied differently. And so this is, I think, one of these interesting dynamics around, how do we carefully steward the growth of the market, but not sort of constrain the growth of the market and push pricing kind of beyond something reasonable. I'm just curious, any thoughts you have as you see, where we are today?
Yeah, I mean, I can see that is certainly a risk, and it could be a problem. What I can say is, at Lloyd's, yes, syndicates do have, a set plan and a set bucket that they can fill with premium. But the really proactive syndicates who are watching what they're writing constantly can see when that's getting full, and they can apply to Lloyd's for an increase there. And we've committed to being thoughtful, but as speedy as possible in responding to requests for growth. We will take a look at how the exposure growth balances against the premium growth, but we're open to those requests, and we deal with them as quickly as we can while being careful about it.
Yeah, fair enough. That's good to know. I suppose last question that I'll put to you before we move on would be with regards to data. Of course, that's always been something that's been complained about with cyber. We'd love to have more historical data than we do, and it's important. We'd love to have better data on where the exposure sits and how it aggregates. Cloud providers, of course, as an example. I guess this is a place I think companies like ours and the industry at large have tried to make some significant improvements over the years. So, I guess my question would be, has that come through? Do you feel like the industry has made improvements in this regard? And from a data perspective, what would help even more?
I do feel the industry has made improvements, but I also know that we have a really, really long way to go. Yes, at Lloyd's specifically, we've been banging on about data for at least a couple of years, and I think things really are improving. We've reviewed what some syndicates are doing, and there are some really forward-thinking syndicates out there that are pushing hard on this, and who are using potential sources of information around the risk that they're underwriting, where they can't get that information directly from their broker or from their client. It's, to me, with my property reinsurance sort of background, it's completely incomprehensible to me that you could underwrite something without knowing, what you need to know about what influences the riskiness of what you're underwriting. So, we're trying to promote as a bare minimum, a set of data fields that we think the market should be collecting for cyber underwriting and more specifically for cyber exposure management. You can't really begin to analyze your exposures or do any sort of modeling, even scenario modeling, if you can't classify your risks into different industry classes, or if you don't understand your exposure to cloud providers and things like that. So last year, Lloyd's published these 5 minimum requirements, data points that we think underwriters and exposure management should be capturing and using. And we're also supporting a market-wide initiative to create an open data standard for cyber risk, to enable this kind of information to be shared much more easily and consistently throughout the market. I think that's in the very early stages of development, but that'll be something that we certainly promote going forwards. And by introducing these 3 new, 1 old RDSs, we're pushing the market to doing more analysis and more modelling of their risk. And in order to do that, they're going to have the data. So we're creating the demand for the data, hopefully, and also promoting ways in which the data can be supplied.
Well, thanks. Very much appreciate the efforts you're doing in that regard. I think we all benefit as that improves. Much more we could talk about, but I think that's a great segue to move on to the other speakers in the webinar. So Ali, Emma, thanks for the time, and then Ali, back to you.
John, thanks so much. It's really interesting to hear the Lloyd's perspective, and Emma obviously brings a wealth of experience. And, to be able to look behind the curtain and hear a little bit more about the processes is fascinating. So thank you. Next up, we have Chelsea Law. Chelsea has been with CyberCube for nearly 18 months now, and I'd love to bring her into the conversation. Chelsea, welcome. Thanks for joining us. And maybe you could just briefly introduce yourself and give us some of your background.
Thanks, Ali. Yes, and hi to everyone. So as Ali mentioned, my name is Chelsea Law. I'm a client product advisor here at CyberCube. I've been with CyberCube close to 1.5 years now, and I focus on our single risk products with a specialization in our underwriting tool, Account Manager. So prior to joining CyberCube, I did spend a number of years at a large primary carrier where I focused on all lines of E&O as well as cyber. And I had the opportunity to work with both wholesale and retail brokers. And I also had the opportunity to underwrite in both soft as well as hard market environments.
Fantastic, Chelsea. So let's kick off. You mentioned the market conditions. What do you think are the drivers of the current market conditions, and what do you think are some of the biggest differences working in a hard market to your previous experience in a softer rating environment?
Yeah, so really interesting question, and I think I joined my last role as an underwriter at a really interesting time. So when I first started, I was working in a soft market, and then towards kind of the end of my underwriting career, I was operating in more of a hardening market. And I think that, in terms of drivers, I think it may be kind of obvious that market economics is probably the root cause of what drives a hard or a soft market. So in a hard market, I think it really just boils down to an imbalance of supply and demand. So for insurance, that translates to a lack of capacity and increased demand for cyber insurance, given the uptick in recent events and the current threat landscape. But I also think that it's important to note that a hard market is also reflective of unprofitable market conditions and perhaps reaction to higher loss ratios. So we saw underwriting results showing unprofitable conditions and perhaps underpriced risk, which in turn I think led to carriers pricing risk to more adequately cover the claims that they were seeing. And to really kind of tie that back to what I just mentioned in terms of economics, I think it makes sense, right? Because not only were the unfavorable results causing carriers to pull back on capacity or leave the market, decreasing that market supply, but they were also able to increase prices, which of course is always a result of higher demand and less supply. And so to get to the second part of your question, I think that on a kind of day-to-day underwriting level, the biggest differences between a soft and a hard market from that standpoint, from specifically, like a cyber underwriting perspective, is that I found myself probably putting a much stronger emphasis on that more technical underwriting. So I found it was crucial to ensure that you're really digging into a company's IT infrastructure and risk management controls and so on and so forth. But in general, though, deploying capacity in an informed way is really, truly the underwriting focus. And Emma mentioned this earlier. So I also do think this does become more scrutinized probably in a hard market. But I really think that as long as you're maintaining consistency and making those informed decisions, underwriting in a hard market is really not that much different from underwriting in a soft market. So, you may write, more accounts and hit your goals quicker in a hard market, but at the end of the day, you still want to make sure that you're choosing the right risks.
Thanks, Chelsea. And certainly in theory, as you say, the conditions should not inform the scrutiny or the level of rigor of underwriting. But of course, the reality may be somewhat different. Maybe if you could just move on, talk to us a little bit about the competitive landscape. And particularly between carriers and some of the new emerging players in the market. How are you seeing that play out, not just in pricing, but also terms, conditions, and other ways and services that are being offered?
Yeah, this is a really great and kind of interesting question. So I think that towards the beginning of 2021 and really at the time of my, at the end of the time at my kind of previous role as an underwriter, I would remember instances where I was still losing out on risks due to pricing. So there would be times when I needed rate to justify the renewal or, even consider certain terms just due to the nature of an account or, a hairy loss history and so on and so forth. And even despite being in a hard market, I did still see some competitors willing to write the risk for less if it made sense from their underwriting philosophy. And I really think that's just it, right? So this question comes down to each carrier's own underwriting philosophy and kind of how they operate regardless of the state of the market. So some carriers are willing to hit those kind of short-term growth targets as, that's what's important and meaningful for their own business model. But there's also always going to be those more established carriers who might take a more conservative or disciplined approach to target better loss ratios and prioritize that long-term growth, because that's what's important for their business model. And it doesn't mean that one is better than the other, because I think that both are super important to not only the underwriting, but the insurance ecosystem. So in my opinion, it's more important to adhere to that underwriting philosophy in a consistent manner, regardless of which model you align with. And kind of putting on, my data analytics hat and adding that to this conversation, I'd argue that it makes more sense to pivot and learn based on trends over time, rather than maybe like one outlier of loss in the market. And what I mean by that from a cyber underwriting perspective is that one loss might not impact your overall underwriting stance, but rather a trend in losses, so such as the increase in ransomware losses and threats that we've seen in recent years. So kind of with all that being said, and to get to this key point, I do think the market is reflecting that in terms of competition. So there's still competition on certain risks that are in a favorable industry and that have great controls despite being in a hard market. But there's also those hard to write risks, like say an MSP, or honestly, really any industry with poor controls. And I think that also addresses the question on the impact to policy T's and C's as well as pricing. So first, for policy T's and C's, given the trends that I mentioned that we're seeing within the threat landscape, we have seen stricter T's and C's and tightening of certain coverages from carriers. So things like co-insurance, higher waiting periods, cyber extortion sublimits, and so on. Or flat out exclusions, depending on the risk that you're looking at. But we also see, exclusions or restrictions such as things on war and terrorism, given the conflict in Ukraine. To get to the pricing piece of things, I think we're still seeing rate increases, but I also think that these are becoming a little bit more modest than what we were seeing in, say early 2022. And then one final point that I'll make here is kind of related to capacity deployment. So we're also seeing an increase in insureds willing to take risk on themselves if pricing was, too high or they weren't able to procure limits. And they're also looking at ways of alternative risk transfer, such as, captives. And I think this was especially true for those larger insureds that were purchasing those, bigger towers. So let's say they couldn't fill the tower either due to lack of capacity that I mentioned before, or markets unwilling to write it, or even just due to pricing. So really kind of overall, I think underwriters are just digging deeper to ensure that they're writing those best risks. And that, of course, in turn will influence the policy T's and C's as well as pricing.
Absolutely, no, I couldn't agree more. And I think that not only is the market having an impact in terms of the pricing and the terms, but also the process. And I think the actual underwriting questions being asked, you said there's a lot, people are digging deeper now. Do you think there are sort of minimum standards or a core set of underwriting requirements for cyber risk these days that perhaps didn't exist a few years ago? And if so, maybe you could just explain your views on what those are, or what the core items should be.
Yes, I definitely think that there are kind of minimum standards now. And again, I really think this goes back to that underwriting philosophy point that I made, right? So carriers are gravitating towards those best-in-class risks, if you will, in the market. And in order to really find those risks, a deeper understanding of both exposure and security has to be achieved. So they're definitely setting a level of those minimum insurability requirements, I would call it, to consider rating risks. However, those risks and those requirements, again, are going to vary slightly carrier by carrier. So as you mentioned, we definitely see more questions being asked on applications, or ransomware or other supplements being required due to the increased need to figure out, which risks I think are, truly favorable from your own underwriting philosophical standpoint. So that is what leads into those longer and more in-depth applications, because underwriters are ensuring that the risk is adhering to minimum cybersecurity standards to even consider coverage. And I think in terms of specific controls, Again, I would say that those two probably vary due to underwriting opinion, or even maybe, the kill chain of attack that a threat actor is taking. But in general, I would say that the most important controls, and probably those that we commonly see on applications or supplements, are things like MFA on remote access ports, endpoint detection and response, so EDR, encryption of data, and offline data backups. But I also think that things like employee training, admin privileges, and things like incident response plans and business continuity planning is super important as well. And then one final interesting and important concept that I want to raise on this is that, related to kind of incentivization, if you will, by insurance carriers to its insureds. So we see carriers offering things like, pre-breach training services, expert panels, breach response, and so on and so forth. And I think that's not only good for the insured, but it's also good for the carrier, right? So it really enables also the relationship between the insured and the carrier to be viewed as a little bit less transactional, if you will, and more so as a partnership in risk management. And it really gives insurers a role beyond just simply risk transfer. But it also helps address the minimum standards of risk mitigation or management that the underwriter is kind of requiring that I mentioned before.
Thank you. No, I think that's a really important point, that there has been an evolution in the cyber market from an indemnity position to now much more of a services-based offering. And I think that pre and post-loss services have really made a big difference. And you talked about some of the specifics in terms of the features and technologies that could help identify a good risk from a bad risk. In terms of the specific analytic signals, I know obviously you focus a lot on the scanning technology that we have at CyberCube. Could you talk to us a little bit about what are the specific analytic signals that could be valuable to help supplement a company's posture and help get a better understanding of their overall cyber security hygiene?
Of course. So I think that this, again, is probably a trickier question. And I said it before, and I'll say it again, but each carrier's and each, individual underwriter's own underwriting philosophy is really going to, set these standards. So with that being said, I think that's why it's important for an analytical tool to be able to cater to multiple use cases and to multiple different philosophies, but also to enable underwriters to have kind of an informed and consistent view on risk. So I think that analytical tools should be able to offer kind of an expert or third-party view or opinion, and should be able to not only augment, but also corroborate the information already available to an underwriter in an application. And so I think it's extremely important for a tool also to capture kind of a holistic or a big picture view of a company's cybersecurity hygiene or posture. And what I mean by that is it should show multiple signals across multiple areas of cybersecurity hygiene. Another thing that I want to mention here is, and also something, and probably the biggest thing that I've been hearing from the market, is really being able to look at signals relative to incident data. So here at CyberCube, we actually did just that. And we studied our analytical signals against cyber incidents. And what we were able to do was identify the top 10 account manager security signals that are most indicative of future cyber incidents. And these are what we call critical risk factors. And I would argue that these are probably the most important signals to look at when gauging cyber hygiene. So these include things such as, ransomware infections, open ports and software vulnerabilities, just to name a few. But honestly, any signal that's highly correlated with future cyber incidents is going to be extremely valuable, in my opinion. And then kind of changing gears a little bit, I also think that something that's super important today is looking at a company's supply chain risk. Because that's becoming more and more of a concern. And I think it's important to be able to have a tool that illuminates a company's technology stack. So what vendors are they potentially relying on, but also, on the flip side of things, are they using positive risk management technologies such as MFA or SIM technologies? And then finally, I think that context of signals is key, right? You can show the signals, but what do they actually mean? So not only should the signal show a binary kind of snapshot of the metrics and whether or not they're observed, kind of for that fast flow underwriting and identifying red flags, but I think that they should also show benchmarking, right? They should allow underwriters to benchmark the performance of the metrics that the signal is measuring against that company's or that risk's peers. And so that kind of adds on to next steps, right? Those are super important too, that kind of so what piece. And so actionable insights that help guide underwriters towards those next steps and kind of arm them with questions to ask or where to look for more information are definitely imperative for an analytical tool to provide. And then lastly, kind of tacking on to that context piece, observing a signal's performance over time is important, right? Like super important. And I made this point before, but I really want to drive home the fact that I think looking at trends or anomalies over time is much more meaningful than simply just observing a signal and how it looks when you run an analysis. And that's why I think the historical trends in Account Manager are extremely useful, because not only can you observe the trends of a signal's performance over 6 months or 12 months to align with a policy period, but you can also observe trends within those signals over time to kind of identify areas where deeper investigation may be needed. So essentially, to summarize, I think this boils down to two key pieces, right? A, the exact signals of interest are going to undoubtedly change based on each carrier's approach, but there's a few things that are consistently being scrutinized. And then B, not only are the signals themselves important, but also the context of the signals is key to, provide deeper meaning, including being able to observe the performance of a signal's metrics over time.
Chelsea, thank you. Wow, that's a lot of information to take in there. But thanks so much for your obviously passionate about the subject and clearly got a lot to share. So thank you very much, Chelsea. I'm sorry we have to cut that off so we can make sure we've got time for Will. Just a reminder to everyone on the webinar, if you have questions, we've got a couple in already. Feel free to use the chat function. And with that, I'm going to introduce Will. Will Hatcher has been part of the CyberCube team for coming up a year as well. Will, maybe you could just introduce yourself, please.
Yeah, absolutely. Thank you, Ali, and it's great to be here today in front of this audience. So, hello everyone. My name is Will Hatcher. I am a client product advisor here at CyberCube. So I hold a similar role as Chelsea, although I'm a little more focused on our broking segment, a little more focused on our product broking manager that tailors specifically to brokers. Prior to joining CyberCube, I spent just about 5 years in the broking space at a large retailer where I was a cyber and tech E&O broker, initially beginning my career out on the West Coast, where I was able to build up a small book of business, and then moving back to closer to home in the Northeast. And, similar to Chelsea, I guess you could say I had the great fortune of witnessing, that transition from a soft market to this hardened market that we've all grown so accustomed to. So hoping I can lean on my prior experience, in the market, as well as my current experience here at CyberCube to lend some insight today.
Will, thanks so much for joining us, and it's great to have you. And now we're gonna turn the tables. So we've heard from the underwriting side of the house, and of course how important it is to have a high level of scrutiny and have, identify the best possible risks. But if you could just put your broking hat on for a moment, talk us through, what do you think some of the biggest challenges for a broker are that they are facing, given the capacity crunch and some of the other issues that Chelsea touched on?
Yeah, absolutely. It's a great question, and it's a great place to start. And there's so many different directions that I think we could take the conversation. And so what I'll really do is just maybe focus on two primary challenges that I experienced when I was in the market, and that I know continue to ring true today, based on some conversations I've had with some of our broking clients. And I think the first one, right, simply put, is just being able to secure adequate coverage, achieve kind of a standard renewal for your clients. In this market, we've seen carriers employ a number of different corrective measures. We've heard from Chelsea on a few of those, but really in the form of things like coverage restrictions and broadened exclusionary language, a lot of upward pressure on retentions and waiting periods. And then also something I like to refer to as kind of a diffusion of limits, where you have this expiring, let's say 10 million, aggregate limit, and you're finding yourself as the broker having to renew it with sometimes 2, 3 carriers, all committing some limit to kind of round out that 10 million. And so, all of these, and that's really, an indication of the severe pullbacks that we've seen on capacity across the market. All of these together are just mechanisms that carriers have employed to kind of mitigate their exposure, in the context of threat environment and the loss environment that we've all experienced over the last, call it 2 years. And while I certainly, will go so far as to say that, some of those methods are certainly justified, on the flip side, from the broking perspective, it makes it much more difficult to achieve a favorable outcome, for your client. Oftentimes, we're seeing companies having to accept programs that are, seemingly less robust and just very structurally different, right? Whether that means higher retentions or whether that means, more layers to achieve the same amount of capacity or really just less limit in general. So again, securing adequate coverage, it may sound, simple, but it continues to be a challenge for brokers in this market. And then, another challenge that comes to mind too is something that has been around forever, I think, across all lines of business, but is certainly exacerbated in a hardened market. And that's simply just managing expectations with clients throughout the life cycle of the renewal. And I think what makes that so difficult in the cyberspace is the fact that carrier appetite is constantly moving. It seems to have become somewhat of a moving target. I can recall on so many occasions speaking with underwriters where I just felt like the conversation was almost a snapshot in time, almost contingent upon, what transpires in the market at the conclusion of that conversation up until the actual, effective date of the policy. But I think, this has manifested in a couple of different ways in the market. And just to name, a few here, I'd like to start with budgeting. So a lot of the times insureds, particularly those who are purchasing larger cyber towers, require premium estimates well in advance of the renewal so that they can set a budget internally. Now, it becomes difficult for the broker to provide accurate pricing to them, in advance because of carrier appetite and the fact that it changes so quickly, right? Appetite in one moment might suggest that a carrier is willing to, price the risk at a certain rate, and that might change, a few weeks later based on what might transpire in the threat environment or potentially on, their particular performance in that specific class of risk. So that makes it really difficult. And as you can imagine, it can lead to particularly some conversations that involve some tension between all parties in the transaction, so underwriters, brokers, and clients. But I think even furthermore, if you get up to a renewal and it turns out, hey, we finally got this tower quoted, but it turns out pricing is 25%, 40% over what we had budgeted, that may lead the client to then go seek structural change in their program. So maybe they want to see pricing at a higher retention. Maybe they're now considering a little more seriously taking some of that limit, into a captive if they have one. So it can lead to some unintended consequences, but it's certainly a challenge in terms of managing expectations, throughout the renewal itself. And then the final comment on this would be on underwriting information, and specifically the pace at which that information changes. It seems like every other week something happens that requires, a deeper level of understanding from an underwriting perspective, from an exposure management perspective. And that makes it really difficult as the broker, when you're having a pre-renewal strategy meeting or a renewal strategy meeting and you're saying, hey, this is everything I need to go out to market so that we can secure terms on your behalf. But then it turns out, the closer you get to the renewal, additional questions come up because of what may have transpired in the market. And then on top of that, right, certain carriers, and Chelsea kind of alluded to this in terms of underwriting philosophy, certain carriers place an emphasis on certain controls more so than others. And so as you're having to build these programs, oftentimes with more and more layers, right, excess layers, some of those excess markets won't just simply accept the underlying submission information that you're providing. So you'll have to at times kind of cater to each, individual appetite. So all of this just makes it really difficult to streamline the renewal process for brokers.
Thanks a lot, Will. That was a very comprehensive summary, and for some of the brokers watching, I'm sure there's a lot of head nodding as they're figuring out and recognizing a lot of the issues that you've raised. So you've set out all the challenges. How can the typical broker in this environment actually get ahead and support the client through that transaction? What is the best the key steps that they can take to help them prepare in those, what are the topics, the priorities in those early pre-renewal conversations?
Yeah, absolutely. And I think, that's kind of the golden question, and running the risk of falling on deaf ears here. I think the first thing that really comes to mind, and this is just easier said than done, but the first thing that comes to mind is just starting the process early, right? I've heard kind of 150 days out from the renewal date is often a good time to initiate that, pre-renewal strategy meeting with the client to really set the stage. And just broadly speaking, right, the sooner that you can identify any potential problem areas, the sooner that you can resolve them before carriers are getting ready to quote. I think a good practice to get into is, especially for renewals, is reviewing expiring submission information and being able to identify those problem areas, right? Chelsea mentioned those minimum security requirements. If you review that submission, or you can recall a particular area, of that risk that posed a problem during the last renewal, you definitely want to get out in front of that to the extent that you can. So starting early, I think, is kind of the first item here. And then, in terms of other ways that you can help prep clients ahead of the renewal, get them ready, kind of contextualize what's going on in the market. I think this is where analytics can play a very important role. And specifically being able to leverage some of that outside in data, that external security data. We heard Chelsea speak at length about those security signals and how important they are for underwriters during risk evaluation. So, increasingly so, right? Underwriters are running those network perimeter scans, and they're flagging those signals that indicate poor risk posture ahead of the renewal. And I really think that brokers, right, to the extent that they can, should be surfacing any of those negative observations to their insureds before the quoting process to stay a step ahead of the market, right? Really asking themselves, how can we anticipate what might slow down this renewal, and how can we avoid that? Our analytics here at CyberCube can reveal this data and also provide, that additional context, right? The kind of so what for brokers to really help them remediate any identified issues with their clients, before the quoting process. That's not to say that, 2 weeks before renewal, a carrier runs a scan and something else pops up. That's certainly a possibility, but I think you're really conducting a comprehensive approach to try and, present that risk in the best possible light that you can. I think another area from an analytics perspective that comes to mind is financial loss modeling and, cyber risk quantification. We heard a lot from John and Emma on kind of exposure management and aggregation risk, but from a single risk, underwriting and broking perspective, really being able to address that question of, okay, what is my client's financial exposure to cyber risk, right? If they were to suffer an event, how much could it potentially cost them? What is driving their exposure? And then what are some coverages that are most important for them based on answers to those questions? So I think especially during a time when carriers are really restricting terms and conditions and capacity is under duress, I think having answers to these types of questions can really help brokers navigate their clients, through this environment and through that renewal process. And then a final point I'll make on this as well is benchmarking, but from a risk transfer perspective. Many of our clients have found value in being able to convey to insureds the percentile of risk that they and their peers are insuring to, as opposed to simply how much limit, is being purchased. And I think this is an important distinction, right? Because you want to make sure that a company understands what a particular limit amount means in the context of their own unique risk profile. Does 10 million in limit mean I'm transferring 80%, 90% of my financial risk? And then once you understand that, right, what are my peers doing? What is their risk appetite, in this segment? So we've seen risk transfer benchmarking, in our broking manager product become a very important component of, renewal strategy for our clients as well.
Fantastic, thanks, Will. And certainly, as you say, it's rather than trying to second guess the underwriter, it actually allows the broker to get in, sort of into the guts of the risk and sort of work with the client shoulder to shoulder. So just to wrap up, and we only have a minute or so left on this section, are there any specific tips or suggestions that you would give your former self in that role as a broker, trying to help clients navigate this market?
Yeah, absolutely. We might need a few hours if I'm giving my former self some tips, but absolutely, I think that's a great question. And unfortunately, I think a lot of the answer to that question can really rely upon the maturity of the insured's cybersecurity program that you're kind of working with. But I would say, just to highlight a few specifics in terms of, hey, how can we best present a submission to the marketplace, as of today? I think the first thing is really being able to satisfy those minimum security requirements. So Chelsea kind of rattled off a few of them: MFA, EDR, backups. I think email, filtering technologies is becoming very important as well. These all remain, in some respects, depending on the class of risk, a barrier to obtaining coverage. That's just kind of like a baseline, item that you need to check off, during the renewal process. And I'd say second, off the back of my earlier comment, is really reviewing that external security data with your clients to get ahead of the market. So being able to surface any negative observations on their network and working with the relevant stakeholders at that client to address those issues, or to at least provide a little more context around those issues, because that underwriters are going to be asking those questions. And then lastly, just to focus on a few other areas that I think are still very much top of mind for underwriters. One of them being supply chain security, right? Systemic risk continues to unsettle insurers in this market, especially on the heels of the variety of events that we experienced last year. And so I think anything that you can do to evidence, a robust vendor risk management program, provide carriers the visibility into how you're managing third-party risk, becomes a true differentiator in a submission. And then lastly, right, we focus on preventative security quite a bit, but I think we've all grown accustomed to that sentiment of, it's not a matter of if, but when. So I think, and Chelsea, hit on this earlier as well, but really being able to showcase a business continuity plan, incident response plan as well will be very important, right? If an insurer suffers a loss, they want to know that those costs are mitigated as much as possible.
We're going to have to leave it there, I'm afraid, because we're running up on time. But Will and Chelsea, thank you so much for your insights. We've had a few questions in from the audience, so thank you very much for sending those in. The first one is to Emma. In addition to observing the evolution of cyber models, will there be compulsory requirements for the syndicates to have some form of cyber risk quantification? Can you share any thoughts on that?
Yes, is the answer. I mean, if I take the question at face value, yes, syndicates really must be doing some sort of cyber risk quantification. We are observing the evolution of models. We're not planning to require syndicates to use any given model or any given methodology, but syndicates must have a methodology of some sort to quantify and understand the risk that they're taking on and ensure that they've got the capital to support it.
Very good, thank you. I've got one final question. If Chelsea, you're still on the line, hopefully. Chelsea, how do you think underwriting standards will change in the future?
Yeah, that's a really great question. And I think this probably depends on what we see with the year-end results. So I can't really predict this. I think if we have favorable results and better loss ratios, I think the underwriters will probably, loosen up on some of those standards. But I think that, going down the line, I think that some of those key standards that I mentioned before are here for the long haul, right? Like, if anything, we might even add to them.
Fantastic. Well, I'm afraid that's all we have time for today. It's been a fascinating canter through some of the related themes of firstly Lloyd's and the regulatory environment and how RDS is developing, Chelsea and her perspectives on underwriting, and Will, of course. So with that, thank you everyone for your time in participating in today's webinar. I hope those of you joining us today have learned something to help you on your underwriting journey and for underwriting and broking cyber risk. I appreciate that there's a lot of information that we've shared over the past hour. This session has been recorded, so there will be an opportunity to rewatch it and share it with your colleagues and contacts. We hope you can join us on Thursday, July the 7th, for our Need to Know webinar that will be focusing on CyberCube's global threat briefing. You can register by scanning the QR code appearing on your screen. If you want to find out more about market regulations, underwriting, or broking cyber risk, there is a host of information on our website. We've referenced our Account Manager and Broking Manager products today. More information can be found on cybercube.com. Alternatively, feel free to reach out to us by sending us an email at info@cybercube.com. For CyberCube, I'm Ollie Brew. Bye-bye.